DraftKings, America's leading digital sportsbook, operating in 27 U.S. states with 4.2 million monthly unique payers and a new prediction markets product opening wagering where traditional betting is prohibited.
FY 2025 revenue $6.05 billion at near break-even. Q1 2026, the first GAAP profitable quarter, $21 million of net income. The decade-long cash burn is over.
Jason Robbins, Matt Kalish, and Paul Liberman co-founded DraftKings in Boston in December 2011 as a daily fantasy sports platform. The MLB partnership in 2013 gave them early distribution and credibility.
The 2018 Supreme Court PASPA ruling legalized state-by-state sports betting, and DraftKings pivoted immediately, competing against FanDuel for first-mover market share by spending billions on customer acquisition.
The 2020 SPAC listing peaked near $70 before collapsing below $10 as rates punished cash-burning growth companies. By 2025, unit economics normalized, and DraftKings finally became profitable.
The sportsbook generates 65% of revenue, online wagering on NFL, NBA, MLB, college sports, and international events across 27 states, plus DC and Puerto Rico.
iGaming, online casino, contributes 20% at higher margins than sportsbook. DFS and predictions combine for 15%. DraftKings Predictions opens new geographies at dramatically lower acquisition costs.
FY 2025 revenue $6.05 billion, grew 27% at 41% margin, near break-even after burning $2 billion annually in customer acquisition.
Q1 2026 revenue $1.646 billion, up 17%. EPS 20 cents crushed the 3-cent estimate. EBITDA $167 million, up $65 million. Revenue per user up 21%.
FanDuel, operated by Flutter Entertainment, is DraftKings' primary rival, holding a narrow national market share lead. Both companies have essentially duopolized digital sports betting in the United States.
BetMGM and ESPN Bet trail significantly. Caesars Sportsbook is contracting. The two-player race between DraftKings and FanDuel is settled. The rest fight for scraps.
DraftKings' moat is its database. 4.2 million payers with accounts, payment methods, and behavioral data. Switching requires recreating all of that from scratch.
DraftKings operates in 27 states plus DC and Puerto Rico for sports betting, about 53% of the U.S. population. 5 states for iGaming. Alberta, Canada launches July 2026.
DraftKings Predictions is live nationwide. 69% of Q1 2026 volume came from states where traditional betting is prohibited. It acquires users at 80% lower cost than the sportsbook.
Jason Robbins is co-founder, CEO, and chairman, a Duke grad who built DraftKings from a fantasy startup to a $6 billion sportsbook while retaining voting control.
Before DraftKings, Robbins worked in analytics at Capital One and marketing at Vistaprint. He led the company through PASPA, the SPAC listing, the collapse, and its first profitable quarter.
DraftKings, America's leading digital sportsbook, $6.05 billion in FY 2025 revenue across 27 states with 4.2 million monthly unique payers and a new prediction markets product opening wagering to states where traditional sports betting is prohibited.
Q1 2026, the first ever GAAP profitable quarter, net income $21 million on $1.646 billion in revenue, adjusted EPS 20 cents crushed the 3-cent estimate. The decade-long cash burn era is over.
NFL playoffs, Super Bowl, March Madness, every single one of those is a Q1 event. And for DraftKings, that means Q1 is their Super Bowl too. The quarter where handle peaks, marketing intensity peaks, and the profitability story either proves out or it doesn't. This quarter, the EBITDA inflection finally showed up. Let's dig in.
DraftKings is the leading digital sports, entertainment, and gaming company in the U.S. 2 pillars: online sports betting, where customers wager on game outcomes, and iGaming, casino-style slots, blackjack, and table games on your phone. Revenue comes from a net revenue model. The company keeps a percentage of every dollar wagered after customer winnings. That percentage is the hold rate, and improving it has been the central operating story for the past 2 years.
Market structure context. Online sports betting is legal in 25-plus states after the Supreme Court struck down the federal ban in 2018. iGaming is far more restricted, live in only 5 states as of Q1 2026. Each new state legalization is a market opening, which is why the regulatory calendar matters. DraftKings and FanDuel together hold roughly 70% of the market in mature states, an effective duopoly.
Q1 2026 revenue of $1.646 billion, up 17% year over year, beating estimates. Sportsbook revenue grew 24% to $1.9 billion. iGaming grew 9% to $461 million. The 24% sportsbook growth was driven by a higher hold rate. The sportsbook net revenue margin expanded from 6.4% to 7.8%. For every $100 wagered, DraftKings kept $7.80 instead of $6.40. That 140 basis point improvement flows almost entirely to the bottom line. Monthly unique payers, or MUPs, came in at 4.2 million, down 4% year over year. But here is the important asterisk. That decline is almost entirely explained by DraftKings exiting the Texas lottery business. Excluding lottery, MUPs grew 2%. Meanwhile, average revenue per MUP increased 21% to $131. So the company is monetizing existing customers significantly better, even as headline customer count looks flat.
The headline profitability number is adjusted EBITDA of $167.9 million, up from $102.6 million in Q1 2025. That is 64% growth year over year. And critically, the company posted its first-ever GAAP net income of $21.1 million, swinging from a net loss of $33.9 million a year ago. Adjusted diluted EPS was 20 cents, well above the 43 pence estimate. On a GAAP EPS basis, the company reported 3 cents versus an estimate of negative 0.44 cents.
For the full year 2026, DraftKings maintained guidance. Revenue of $6.5 to $6.9 billion and adjusted EBITDA of $700 million to $900 million. The midpoint of that EBITDA guidance, $800 million, would represent an extraordinary acceleration from the $167 million delivered in a single quarter, which is why the remainder of 2026 will be closely watched. Q3 is seasonally the weakest quarter for sports betting due to the summer sports calendar.
Behind all of this is Jason Robbins, who co-founded DraftKings in 2012 alongside Matt Kalish and Paul Liberman. Robbins spent years lobbying state legislatures before sports betting was even legal, and since the 2018 PASPA ruling, he has been the face of the state-by-state expansion campaign. Under his leadership, DKNG went public via SPAC in 2020 and delivered the company's first GAAP quarterly profit in Q1 2026. He is now focused on the super app vision and prediction markets as the next frontier.
Wall Street's central question on DraftKings has always been, when does this become a real earnings story? The profitability timeline was the dividing line between bulls and bears. For several years, the bull thesis required patience and faith that scale economics would eventually convert massive customer acquisition spend into durable profits. Q1 2026 is the first concrete data point that says yes, that conversion is actually happening.
But the street is not declaring victory yet. The FY 2026 EBITDA guidance range is wide, $700 million to $900 million. The midpoint requires Q2 through Q4 to collectively deliver around $630 million in adjusted EBITDA after just $168 million in Q1. Q3 is always a soft quarter because the NFL schedule is light and summer sports betting volumes are down. Whether the full-year guidance is achievable depends heavily on holding the 7.8% sportsbook margin in Q4 when NFL returns.
The FanDuel competitive dynamic is part of every analyst conversation. Flutter's FanDuel retains the top market share position in U.S. sports betting with somewhat better unit economics from its parent company's international technology base. DraftKings has been closing the gap, but the duopoly is expensive. Both players spend heavily on promotions. And state tax risk is the sleeper issue. Illinois raised sports betting taxes to as high as 40% for large operators in 2024, and other states are watching. A wave of similar moves could partially offset the hold improvement story. The bull case on DraftKings rests on 3 compounding drivers. The first is EBITDA inflection. Q1 2026 showed $167.9 million in adjusted EBITDA with FY guidance of $700 to $900 million. If the company hits even the low end, it establishes a credible path to multi-billion-dollar annual EBITDA within a few years. That would be a genuine multiple re-rating event.
The second driver is structural hold improvement. The sportsbook net revenue margin going from 6.4% to 7.8% is not purely good luck. Management attributes it to same-game parlay product mix, enhanced live betting algorithms, and structural betting market design. These are proprietary improvements that FanDuel and BetMGM cannot easily replicate in the near term. If 7.8% holds or improves in future quarters, DKNG's revenue and EBITDA estimates would need to move significantly higher.
Third driver, iGaming state expansion. Online casino gaming is live in only 5 states, covering 11% of the U.S. population. New York and California are the crown jewels. Each legalization would add hundreds of millions in addressable revenue. DraftKings enters new states as a known, trusted brand against a thinned-out competitive field. The smaller operators have exited. That makes every new iGaming state an opportunity to dominate from day one.
The bear case begins with state tax escalation. Illinois set a precedent in 2024 when it raised sports betting taxes to tiered rates as high as 40%. That dramatically compressed margins for operators in the state, and several states have taken notice. If 5 or 6 large states follow Illinois, including potential moves in New Jersey or Pennsylvania, which are mature, high-revenue markets, the EBITDA inflection story could stall before it fully materializes.
Promotional wars remain a structural cost. The U.S. sports betting industry is still in land-grab mode in several states, and both DraftKings and FanDuel continue offering substantial sign-up bonuses and free bet promotions to win new customers. Disciplined promotional spending is how DraftKings improved EBITDA, but maintaining that discipline while FanDuel and ESPN Bet are aggressive is difficult. 1/4 of heavy re-promotion to defend market share can erase months of margin improvement.
Handle volatility is a risk investors cannot model away. Sports betting revenue is structurally path-dependent on game outcomes. DraftKings' sportsbook margin improved from 6.4% to 7.8% year over year, but that number can swing 200 to 300 basis points in a single quarter, depending purely on whether underdogs cover or favorites dominate. A single NFL playoff season where parlays go the wrong way for the house can produce a quarter that looks terrible on the income statement, despite no operational deterioration.
Finally, the prediction market's expansion introduces execution and regulatory risk. Robbins has announced an aggressive push into event contracts and sports predictions, but this category is uncharted regulatory territory. State gaming commissions may classify prediction markets as gambling products requiring separate licensing. A regulatory backlash could slow what management is billing as the super app's key differentiating feature, and heavy investment ahead of revenue could weigh on near-term EBITDA.
Peers. Flutter Entertainment owns FanDuel and trades at around 2.1 times sales with the top U.S. market share position and better international unit economics from Paddy Power Betfair and PokerStars. DraftKings at 1.8 times sales trades at a modest discount to Flutter, reflecting FanDuel's share lead, but also DraftKings' higher domestic growth rate and the fact that DKNG is a pure-play U.S. story while Flutter is global.
Penn Entertainment operates ESPN Bet with Disney, but trades at just 0.55 times sales. ESPN's brand has not converted sports media viewers into bettors at the expected rate. BetMGM, the MGM and Entain joint venture, sits at number 3 in the U.S. market and has been losing share to DraftKings and FanDuel for several quarters. Both Penn and MGM highlight how difficult it is to build a digital-first sports betting operation without DraftKings and a 12-year head start on product and customer data.
DraftKings is a high-vol earnings stock. The name has moved 8 to 15% on quarterly reports over the past 2 years. Into Q1 2026, implied volatility was at the 72nd percentile, with an expected move around 9 to 11%. The put-call ratio was 0.82, reflecting the binary nature of the EBITDA inflection question. Post-beat, near-term IV should compress, generally favoring call buyers who held through the print.
The seasonal pattern matters. Q1 is DKNG's best quarter, Q3 is the weakest. The Q2 print will be the first real test of whether the 7.8% margin holds outside peak season. Insiders have sold under routine 10b5-1 plans, no unusual open market activity. Short interest is roughly 8% afloat, elevated but well below 15% peak from 2022 when the profitability case was far murkier. The story has de-risked, and the shorts know it.
All right, the bottom line on DraftKings. This is a company that spent years burning cash to build the leading U.S. digital sports betting brand, and Q1 2026 is the quarter where the profitability story stopped being a promise and started being a reality. First ever GAAP net income, 64% EBITDA growth, a hold rate that expanded 140 basis points and appears structural.
The key metrics to watch. Can the 7.8% sportsbook margin hold outside of peak season? Does FY 2026 adjusted EBITDA track toward the $800 million midpoint? Does New York or another major state move iGaming forward in 2026? Those three data points will determine whether DKNG's $36 stock closes the gap toward the $44 consensus target or widens it. Jason Robbins said it plainly. Profitability is inflecting, and we have the firepower to press our advantage.
That is today's Charged Alpha Deep Dive on DraftKings, ticker DKNG Q1 2026 earnings. And if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, and commodities. No sign-up, no paywall. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult a qualified financial advisor before making investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.